Hi everyone, let's focus on my preferred and alternative micro scenario. Starting with my preferred micro scenario, which was an ABC over here. One can also make this a WXY, but the target area doesn't really change. And the target area over here had nice confluence with the double bottom made from the low over here and the low over here for some extra confluence, and also basically a swing failure pattern trade, wicking below, grabbing the liquidity, closing above, and then looking for upside. The potential trading setup here was to ladder the longs inside this area, stop loss below the wick, looking for upside, where basically my first target of interest is the double top at 30.6k, because we have a high over here and a high over here, so there must be some liquidity resting above, and we have to wait and see if price is going to get here, and then if it gets here, what it is going to do. We also have some news coming up today at 2:30 Central East European time, so in 1.5 hours after this video goes live, you can see the high impact news over here, the red flags. So make sure that whatever happens, you trade safe when the news is going to hit. If we then look at this structure over here and we zoom in, I basically have two preferred scenarios that are bullish and two alternative scenarios which are bearish. And I will also explain why the bullish ones are preferred. It basically has to do with the beginning of this count. So over here we have a wave 1, then a wave 2, we have a 3, 4, 5, and inside this wave 3 we then have a 1, 2, 3, 4, 5 over here. Now in this particular scenario, the price is not allowed to, in my opinion, go below this low over here, because the most common targets from a Fibonacci standpoint are the 236, the 382, and the 0.5 for a wave 4. And if you really go below the 0.5 and close candles below here, well, that's not really preferred for a wave 4. So in this scenario, you don't want to see price go below this low over here, and then we would be looking for another move to the upside. If I then show you my other preferred scenario, it's basically a 1, 2, 1, 2, before then a big 3 to the upside, definitely pushing through the double top that we have and not wicking above and going to the downside, but really pushing through to much higher levels. In this particular scenario, the retracement is going to be deeper, so it is quite likely we are going to take this low. Now, the most common targets for a wave 2, if this is then a 1, 2, is between the 0.5 and the 0.786 fib, which is between 30.1k and 29.9k. Now, this is the blue count, a lower degree count than the green count. And what is not that nice about this particular scenario is that this wave 1 over here is much bigger than this small wave 1, even though the green count should be from a higher degree than the blue count. So I guess that from the both bullish scenarios, this one at the moment is my preferred scenario, a 1, 2, 3, 4, 5, compared to this bullish scenario, which is a 1, 2, 1, 2, and then eventually a lot more upside to come. Both are going to the upside, but in this scenario, if wave 5 is in and we might actually wick above these levels, we take the liquidity of the double top. So this then in this scenario, take the liquidity of the double top, move to the downside, and then this move to the downside is basically going to be a wave 2. So this is going to be a 5 wave first, wave 1. Then we have a corrective wave 2, before then a 3 to the upside for eventually higher prices to come. If we then go to my alternative scenario, you will see why these are alternative bearish scenarios, which has to do with the targets. So if this is a wave A, and this is a very nice clear 5 wave count as well in this wave A, we then have a 3 wave in B, and then you would be looking for a wave C. First of all, this wave C is very long in time compared to wave A. Usually it's at least around the 1-to-1 time relationship, or maybe the 1.618 time relationship between wave A and then a wave C. But as you can see, this C is much bigger. And also, in this case, if you count it like a 1, 2, 3, 4, 5, this wave C went all the way to the rare target, which is the 1.618 for a zigzag, and then an A, B, C. So because this is a rare target, it is also less likely, and time-wise, it is less likely. Now, if we then have the other alternative scenario and say, okay, this is not the high of wave C ended over here. So we then have an A, B, and then we have a wave C. Now, this is the most common target area for a wave C, but it is a little bit difficult to count a very nice 5-wave structure in this wave C, because this is then a 1, 2, then you need, well, a 3, 4, 5, something like this, right? And then eventually this is the high of wave C. Then we have over here a 3 wave A, then you need to be looking for a 3-wave in B. So this move over here has to be some sort of a 3-wave structure, which is very difficult to count a 3-wave structure in this move over here. And also this wave B then again went to the rare target for wave B, which is the 1.618. So another rare target being hit. And then you would expect an impulsive move to the downside for C. But if we then have a little look at the divergences that are going on at the moment, you can see that price over here is moving to the downside, CVD is moving to the downside, but the CVD over here at the moment, let's go to the 5-minute to make it a little bit more clear actually. You can see that the CVD that we have over here is lower, the yellow line is lower than the CVD over here. So look at the yellow line, we are making a higher low while the yellow line is making a lower low. So those are bullish CVD divergences, making it more likely that the high of this wave B is going to be taken, and therefore the bullish scenarios that I shared are having a higher probability at the moment. So I hope this video was helpful or valuable to you. I'd like to thank you for watching and subscribing, and I will see you at the next one. Bye bye.